Welcome, and thank you for joining us today as we talk about the valuation of PE and VC portfolio companies in uncertain times. Next slide. So I'm Mike Massey. I'm a partner at Moss Adams, where I lead the Valuation Services Group. I do a significant number of PE and VC company valuations for our external clients for ASC 820, 409A, ASC 718, and review a lot of valuations done for those same purposes for our assurance clients. And I'll hand it over to my co-presenter, Donovan.
Hello all, and thank you for making the webinar. I work in our Sacramento office and cover many of our Northern California offices for Moss Adams. I work closely with Mike in the valuations group and do a lot of the same things, so I won't need to repeat myself, and Mike will take over from here.
Next slide. So today we'll briefly talk about the state of the industry. We'll talk about practical valuation considerations, shifting valuation methods, and finally we'll talk about calibration. All right, next slide. So as you can see in this slide, the number of merger and acquisition transactions has declined significantly in the second quarter. Now this data is through the 28th of May, but as you can see, the number of mergers is way down, as is the dollar value of those transactions. Next slide. We also looked at past bear markets and just how late and early stage venture-backed company values changed relative to the S&P 500, and we found this to be quite interesting in that later stage companies were really highly correlated with changes in the S&P 500, whereas early stage venture-backed companies, they were relatively stable in terms of value, even increasing in the slide on the right-hand side. And maybe this is good news for early stage companies, but it makes sense when you step back and think about it. A lot of early stage companies are pre-revenue, and so these downturns don't necessarily impact that number very much. The current downturn, if anything, might just impact the timing of the development of IP or future products that are eventually introduced into the market. Whereas later stage companies, there can be a significant impact on revenues and earnings resulting from the current pandemic. All right, next two slides. Next slide. So when performing a valuation, you'll often do what we call an income approach, where you project out expected future cash flows for the business and discount those cash flows back to the present using a discount rate that reflects the risk in those cash flows. And one of the things that people are tempted to do in these uncertain times is adjust cash flows for risk, and then because there's uncertainty relating to those cash flows, also add an additional risk premium to the discount rate. And so we want to caution people against, double adjusting for risk. And we believe it's best practice to adjust the cash flows for risk, but not add an additional risk premium for the current state of the world to the discount rate. Similarly, in the market approach, if you're basing value on forward-looking estimates and multiples, if you've adjusted those forward earnings and forward revenues for risk, then you wouldn't apply a subjective adjustment to the multiple that's being applied to those measures. And this is really important now. If you're basing value on historical multiples, it's really important to understand how that multiple is being calculated. And let me give you an example. So if you're doing a valuation as of March 31, 2020, and calculating a multiple based on publicly traded companies as of that date, you want to make sure you take a look at what period the earnings in that multiple are being calculated. So if you're doing a price to earnings multiple, those earnings might go through March 31, 2020, or they might go through December 31, 2019. So understanding the time frame for the earnings used in the multiple calculation and then applying that multiple to the proper earnings of the subject company is especially important now, because those multiples could vary pretty widely depending on the time frame of the earnings. Okay, next slide. A lot of our clients right now, they are struggling with coming up with financial projections for their companies. And so what we're recommending in many cases is that maybe they consider multiple forecasts or projections that reflect different recovery scenarios. And so, depending on whether they're expecting a V or a U or a swoosh-shaped recovery, they might build different forecasts and scenarios and probability weight those scenarios to get to a value today. Next slide. Now, if you're basing value on a pre-COVID financing round, I believe you'll save yourself a lot of heartache with your auditor and really provide a lot of good additional support for your current valuation if you create a quantitative model that is calibrated to the transaction price of that prior transaction. So I'll just give a quick example. If you're involved in a financing round as of December 31, 2019, and you believe that that round reflects fair value, I think it's important that you create this quantitative model that reflects your future expectations for the subject company, and that you adjust, probability weighting and adjust those expectations so that the value implied by that model equals what you paid in the transaction. Then, so that way you have a model that's calibrated to an actual transaction that reflects fair value. Then if you're updating your valuation as of March 31st, you start with that same model that's already calibrated, and you update it for things like, changes in the timing of a future exit event, or changes in exit multiples, or changes in earnings or expected revenues. Update the model, and there you have a new value that's supported by a model that was calibrated to an actual transaction. So really pay close attention later on when Donovan talks about relative value scenario analysis and calibration, because I think those concepts will become more important in 2020 as you're doing valuations based on past financing rounds. Okay, next slide. As we talked about earlier, M&A transactions are way down, and IPO transactions are down early this year, and so it's important to consider how this current exit environment might impact the value of your company, and it won't impact all companies the same. For instance, we have a client right now that is moving more quickly towards an IPO because they got a boost in the current environment, and they're doing quite well as a result of just what's happening in the economy. So, you really need to look closely at the company, the specific company, the industry in which it operates, and understand how the exit environment might have changed and apply that appropriately in the valuation. Now I'll hand it over to Donovan for shifting valuation methods.
Thank you, Mike. Well, keeping in mind the practical considerations we just covered, we'll now discuss the valuation methods you could consider using or changing to. For the valuation of equity instruments in a portfolio company, there are commonly accepted methods which include both the determination of equity value as well as allocation of that value to the different classes of equity. Scenario-based methods are forward-looking and consider one or more possible future scenarios. These include the simplified scenario analysis and the relative value scenario analysis, which both tie to the post-money equity value of a company, as well as the fully full scenario analysis, also known as a probability weighted expected return method, commonly referred to as PWORM. The option pricing method is also a forward-looking method that considers the current equity value and then allocates that value to the various classes of equity, considering a continuous distribution of outcomes rather than focusing on a distinct set of future scenarios. This method employs the Black-Scholes option pricing formula and can be difficult to implement given its complexity. It also is often faulted for employing an assumption of normally distributed returns, which are really often not applicable to early stage companies that have high probability of a very high or very low return, which is referred to as bimodal. The current value method allocates the equity value to various equity interests in a business as though the business were sold on the measurement date, often referred to as a waterfall approach. While easy to understand, the method can fail to assign value to junior equity at low values for a company, as these junior investments typically begin to receive value only after the senior equity, such as preferred stock, receive their return. And lastly, we have the hybrid approach, which is simply a combination of the use of a scenario-based method along with an OPM. Now, in this presentation, we'll focus on the scenario-based methods. If you have any questions on the applicability of the OPM, current value method, or hybrid method, feel free to reach out to us afterwards. The first of the scenario-based methods is a simplified scenario. This approach utilizes the post-money value of equity implied by a recent transaction, such as a financing round or a secondary market sale. The approach is easy to apply and understand, but its applicability can be limited. The simplified scenario analysis approach may be appropriate if the distribution of outcomes for the portfolio company is expected to be bimodal, there goes that term again, with no value on the downside. That is, if the portfolio company is either expected to succeed, exiting at a value that is high enough that all classes of equity will convert, or fail, exiting at a low value that will provide no payoff to the existing classes of preferred. The second scenario-based analysis is the relative value scenario analysis. This lies somewhere between the minimalistic approach of the simplified scenario and the use of full valuation models. This method is useful when enough time has passed since the last financing round or transaction that changes in the company or market warrant a reevaluation of the company, but not enough information is available to produce a traditional income or market approach. These scenarios are calibrated to the most recent rounds and later adjusted to reflect changes expected in cash flows, risk, and possible exits. Thus, the form of the analysis will be dependent on the particular facts and circumstances. Next, we'll run through an example of this approach. Let's assume our subject company has just raised a Series D round that has seniority over the prior rounds. The fund might estimate that there is a 30% chance of success where all classes of equity would convert, a 40% chance of a mid-value exit where the Series D would receive an expected value of 70% of its liquidation preference, but earlier rounds would receive no payoff, and a 30% chance of dissolution where neither the Series D nor the earlier rounds would receive a return. Therefore, the payoff to the earlier rounds would be lower than the Series D by 28%, which would be that 40% chance of the mid-value exit times that 70% of preference received. So if the Series D price was $3, the fair value of the prior rounds, the Series A, B, and C, might be estimated to be $2.16 per share. Lastly, we've got the full scenario analysis, or a probability-weighted present value. This considers all the possible future outcomes. This approach is appropriate when future exits are close at hand and their likelihood can be reasonably projected. The future outcomes in this approach may include an IPO, merger and acquisition, dissolution, or continuation as a private company. Each of these outcomes would involve valuing and allocating the value of equity instruments based on that particular event happening. For example, an IPO scenario would assume the conversion of all equity shares to common, while an M&A scenario may involve measuring a possible exit price and then allocating that price through a current value method or a waterfall. Both an income and market approach may be used in this analysis depending on the different scenarios selected. While this is the most elaborate of the scenario analysis methods, when a company is close to an exit, a simplified or relative value analysis may just not be applicable. Now, Mike mentioned this a little earlier on, but now we're going to cover calibration in our last section. While we only have 2 slides on this, it is very important and it's a helpful topic. Calibration refers to a look back at known fair value indications for a company, like a financing round, and using that value to make better assumptions in our application of valuation measurements at later dates. So said another way, we use observable transactions to inform our unobservable inputs. Let's dive in. Many valuation techniques used to estimate the fair value of a portfolio company or companies in general really require a significant amount of unobservable inputs, which we refer to in accounting as level 3 inputs. They can include appropriate discount rates for discounted cash flow, where in the range of selected peer valuation multiples should an applied multiple be, what projected growth rate of earnings may be appropriate. And these are all highly subjective metrics. So when using a technique that requires these level 3 inputs, it's important to calibrate those to any transaction in the investment itself. When a transaction represents fair value, calibration provides an initial set or baseline of assumptions that can be referred back to at future measurement dates. Let's take a simple example with 2 dates of value, a transaction date and a subsequent measurement date. At the transaction date, you can calibrate inputs of applicable valuation techniques so that the value of the transaction is reached. Very simply, this is how it might look. At date 1, the subject company is purchased at a 10 times multiple of EBITDA, which happens to correspond with the 3rd quartile of a selected public peer group. At the subsequent measurement date, you would update input assumptions for changes in the investment and the market conditions. In this example, at date 2, public companies are now trading with a 3rd quartile of 12 times EBITDA. Based on the calibration, this would imply that the subject company should be valued at this new multiple. As always, though, subject to the facts and circumstances since the last measurement date. Considering where we are now compared to 3 months ago, we know that there can be a world of difference here. There have been additional risks and questions about the future of many industries, and we're having to ask ourselves, so I hope it will be easier for you to successfully navigate those in your evaluation measurements after having listened to this webinar.
So to reiterate,
always, we're here to help.
Donovan, just a second. So just to reiterate,
that last one.
Yeah, just to reiterate, in these really uncertain times, and because most of the inputs to these valuations are level 3, they're unobservable inputs, I believe that relative value scenario analysis and calibration are 2 concepts that are particularly important as you're valuing your portfolio companies and looking to support the value conclusion with your auditors. So definitely keep those 2 examples in mind as you're looking to value your portfolio companies.
Thanks, Mike. It's a great point. Well, that does it for us. We thank you for your time and attention. If you have any questions or you're looking for additional resources, we'd encourage you to check out mossadams.com, where there is just a wealth of information put out by our industry experts covering consulting, tax, and assurance topics. If you'd like to reach out to us directly, feel free to send us an email. And that is it for our presentation. Stay healthy and have a great day.
Thank you. Have a great day.